George, I think you'll take 1 minute.
Yeah, I'm not sure how relevant commercial banks are anymore in this space, but let me try, at least for a minute. So my name is George Kotsovos. I work for Standard Bank. We focus primarily on raising finance for project financing across Africa. Most certainly, our footprint helps us originate the right deals for ourselves and helps clients find the right deals as well. So we work very closely with developers who have got the right track record to approach them and say, well, you know, here's a deal that we should be working together with you on. So given that we're a commercial bank, we're not going to take undue risk in providing development capital to developers, unfortunately. I mean, there's other people who are well positioned to do that. But we most certainly will work very closely with developers to help them structure the right deals. And for us, track record is key in working with developers. So there needs to be obviously a certain amount of capital that they have access to. And we do give preference to developers who've got the right track record. And in those instances, we can provide the same support that comes from DFIs in this space. Thanks, Angela.
Now, George, we've heard from project development side of financing side. We've talked about exit mechanisms. Your view as a commercial bank, with the Basel III rules beginning to bite, what role do you see for the commercial banks moving forward?
Thanks, Angela. Before I touch on Basel III, I want to emphasize once again what my colleague from the DBSA said, which is that for the right project, there's enough money out there. And that applies both in respect of project development funding and also in terms of bank funding. Now, banks can get involved very early on in these transactions through advising clients in terms of the right structures, as we all know, and they ultimately then also provide the funding. So as long as you have the right developer and the right project you're pursuing, you'll be able to get it to market. I mean, we get inundated all the time by investors who are looking to put money into good projects. I suppose the challenge always is that the developer, you know, wants to hold on to as much as possible until later on in the life of the project. I mean, if that's the case, then it boils down to, of course, making sure there's enough capital to take it to a certain stage. It involves having the track record to get a deal to a certain stage. And, you know, we all know the likes of Aldrich and Global across the continent who've had great success, and we're working, you know, with them on numerous deals. And in certain instances, it gets tough when, you know, you're sitting 4 years into a deal and you still haven't closed. I mean, it's a lot of pain for the developer, but at the same time, it's a lot of pain for the banks as well, who aren't getting paid. I mean, the lawyers get paid, but the banks sit there in anticipation of funding down the line. So we allocate resources, DFIs, commercial banks, in working on these projects, and we want them to close, and we can provide support to make that happen, but ultimately it rests on the shoulders of the developer to carry it through. So I just wanted to emphasize really what was said before. And then if you move to Basel III, and it sort of touches on to what my colleague from the JSE said, and yes, Basel III is biting to a certain extent. But what has happened, of course, is that increased regulations have meant that the cost of funds have largely increased for commercial banks. And it doesn't apply to institutional investors. It may not apply to other investors either who are looking to put debt into this deal. So it does get more difficult then for commercial banks to stay relevant in that space. However, there are models that will allow us to continue to be relevant. I mean, after all, there's a massive funding requirement, as we know. I mean, there's billions and billions of dollars required in South Africa and in the rest of Africa to fund the development of infrastructure. And we're just not doing enough as an investor community to actually make this happen. I mean, I don't think people really appreciate the massive, I suppose we do appreciate it, but I don't know if, you know, there's enough being done to mobilize enough capital to actually make these deals ultimately come to market. So commercial banks have to stay relevant, and yes, costs are going to make it trickier for us to stay relevant, maybe for the long term. So what Basel III means is that long-term financing becomes more expensive, becomes more prohibitive for commercial banks. So we have to become innovative, and we have to work ultimately with the likes of the DFIs to put in place risk-sharing structures, and we've done that with the DBSA, we've done that with IFC, we've done that with AFDB, and we'll continue to do so, and we're very glad that they're obviously crowding us into these deals and making us relevant. And together with those partnerships, we're going to be able to raise sufficient capital to make these deals happen. Commercial banks have got liquidity, so it's about how you use it. How do we use it then? Yes, it's about maybe looking at banks providing construction finance initially, and to the extent that they're able to then provide long-term financing, they can do so. Problem is you can't refinance a commercial bank loan into, say, a DFI structure thereafter, because DFIs won't refinance commercial bank debt, as we all know. So it's really about tapping into capital markets. And yes, we are looking at those types of solutions, project bonds, and some of them have been done. We've done one in South Africa. In fact, we listed a renewable energy bond, or at least we did a project bond for renewable energy bond not too long ago. But at the moment, there's enough capital in South Africa to be able to offer financing to long-term projects. When, I suppose, we become too expensive and we're not the sort of obvious choice, then by all means other options will be pursued. And people have been thinking about project bonds for a long time, for capital markets to come and lend. And why hasn't it happened? It's because ultimately, the cost isn't better than what commercial banks can offer. It's because there's listing requirements, and certain clients don't want to do that. They don't want to sort of have the pain of having to have additional reporting requirements and so forth. So yes, it's something that ultimately people have to tap into and do if they do want capital through those means. But the bigger problem for me is the rest of Africa. Is where are we going to get money for projects in Africa? And yes, you can sort of always offer dollar money on a cross-border basis, but it's becoming challenging. We're seeing that right now, where many countries are suffering to meet the dollar obligations because we've seen what's happened to commodities. We've seen what's happened to currencies as a result. So it's really about trying to find structures, maybe hybrid structures, where you can lend a portion in local currency, tap into local markets as well, look at the institutional investors in those markets, the pension funds, to offer, say, 8 to 10 year money, and then on a cross-border offer a bit of a longer term. But the depth of the capital markets in the rest of Africa is just not there at the moment. There isn't enough appetite, there isn't enough, I suppose, tenors available to make it feasible in terms of the tariff for the end user. So we've got to keep those challenges in mind, but it doesn't mean that we shouldn't be looking to help those markets develop. So yes, in South Africa, there's most certainly a lot of liquidity that's slushing around, that's keen to come and co-lend, and I think at some point that money is going to help free up capital for commercial banks, and hopefully we can convince the project bond investors that certain of those deals have been de-risked, and therefore the pricing is going to be cheaper once you're in operations. And that most certainly should be what people should aim to do when they look to refinance into capital markets. But the bigger challenge is what happens in the rest of Africa and how you actually use the local capital markets to do that. And that's where we desperately need the DFI as partners to offer credit guarantees, to offer enhancements, which is the case. I mean, that is most certainly happening. In certain countries, we're seeing IFC offering B-loan structures, which, is helping on a cross-border basis. But, we need to look at solutions for local markets, and that's where the real challenge is. So there's a space for everybody, and I think we've got to work together as a collective to address the infrastructure need. Thanks, Angela.
Thank you, panelists.
Doing business in Africa. You can't afford to be without Africa Investor.